So my background is 26 years in investment management. I spent 15 years in the hedge fund industry, and I did my graduate degree at London Business School, and I'm very happy to say that I teach part-time now on the master's degree program. Frontier was founded in 2005 with an objective to build a Harvard and Yale type multi-asset portfolio and bring that to clients. We began doing research on Harvard and Yale and the top university endowments more than 10 years ago. And for those who don't understand or aren't not familiar with university endowments, these are charitable pools of money that have been accumulated over many decades by donations from former successful graduates. These endowment funds are quite large. In the case of Harvard, it's $35 billion. And this pool of capital is non-taxable and charitable, and is used to fund some of the operating expenses of the university and to provide scholarships. What's unique about them is really two things. They invest that capital in a very unique way, and they have achieved outstanding performance over the past 30 years. One of the very interesting things in our research of Harvard and Yale and the top university endowments, the way they invest is around 50% of the allocation is in equities, both public equity and private equity. But very interestingly, they have a small fixed income or bond investment. It's typically only about 10%. Now, as you pointed out, bonds have been on a big rally as interest rates have declined in the past 30 years. And that is unlikely to continue because interest rates are now at all-time record lows. So for many investors who may have large bond holdings, these are now no longer low-risk investments. A typical bond portfolio would have a duration of perhaps 6 years, and the rule of thumb would be for a 1% move up or down in interest rates, the value of that bond portfolio would move up or down 6%. So if interest rates were to normalize, let's say move up 3%, you could have an 18 or 20% fall in bond portfolios, which for many clients would come as somewhat of a shock. So I think today, if you look and take Harvard and Yale and other large endowments as an example, they have diversified away from bonds, and they've allocated to other asset classes such as real estate, commodities, natural resources, absolute return funds, and private equity. And that's what we aim to do in our multi-asset fund, is reproduce that very diversified asset allocation. I've been coming to the UAE now for more than 15 years. And what I have noticed in the last 3 or 4 years, there is the beginnings of a big change in that investors are starting to recognize the benefits of low-cost index funds. The academic research is very clear in this field. Approximately 75% of actively managed funds don't beat the index. About 1/3 of all assets today on the planet are indexed. So many very sophisticated investors choose to simply buy the index and harvest the return from that particular asset, whether it be equities, bonds, or real estate. And on this recent trip, I've seen a real interest, lots of questions about how people could get access to more low-cost index products. I just would say that we have been a leader in this area of low-cost indexing. Over the past 10 years, within our multi-asset products, we access many of the asset classes using indexing at a cost of approximately 0.1% per annum. This compares very favorably to actively managed fund fees, which can be 10 to 15 times higher than that. So indexing is very efficient, it's low cost, and it captures the return from the asset class. I think that if you look again at the university endowments, which is who we seek to look and do research on each year, we publish a research paper on the top 20 university endowments, and then separately a specific paper on Harvard and Yale. If you look at their asset allocation, their portfolios, what you see is about 50% invested in the stock market, equities, 10% in fixed income, and then 40% is in alternative asset classes, things like real estate, commodities and natural resources, and absolute return. Absolute return is the new kind of growing area in portfolios today, and this means hedge fund strategies and managed futures. At Frontier, in particular, the managed futures strategy, which is a trend-following momentum strategy, is something that we believe in strongly. It's supported by a lot of academic research that shows that asset classes tend to trend up and down more than they should. And so managers in this space tend to have very strong performance in equity bear markets. When the stock market does poorly, this strategy does very, very well and provides a nice buffer in an overall diversified portfolio.